The year is 2025 and the global trade landscape is a powder keg. Tensions simmer between economic superpowers. Nowhere is this more evident than in the escalating trade war between the United States and Thailand. In a move that sent shockwaves through the global economy, the US slapped a hefty 36% tariff on a wide range of Thai exports. This aggressive act sent a chill down the spines of Thai businesses and investors alike. The tariffs threatened to cripple key industries from automotive manufacturing to electronics. The Thai economy, heavily reliant on exports to the US, braced for impact. The tariffs were like a punch to the gut, threatening to slow down economic growth and impact jobs. The Thai baht, the country's currency, took a nosedive in response to the news. Investors, both foreign and domestic, were spooked. The stock market, a barometer of investor sentiment, reacted with predictable alarm. The Stock Exchange of Thailand, the country's main stock market, became a sea of red as share prices plunged. This was not just a blip, it was the start of a full-blown crisis. The situation demanded swift and decisive action. All eyes turned to the SET and the Thai government, desperate for a lifeline. The world watched, holding its breath to see how Thailand would weather this storm. The US tariff announcement triggered a wave of panic selling on the SET. Foreign investors, fearing further losses, headed for the exits, dumping their Thai stocks. The Thai baht continued its downward spiral, exacerbating the situation. The SET index, a key indicator of the market's overall health, went into freefall. Adding fuel to the fire were short sellers, investors who profit from a decline in stock prices. They saw this as an opportunity to make a quick buck, further driving down stock prices. It was a vicious cycle, fear and panic feeding off each other. The SET, once a beacon of stability in Southeast Asia, was now teetering on the brink. The situation was particularly dire for retail investors, often less sophisticated and more vulnerable to market swings. Many had poured their savings into the stock market, hoping for a comfortable retirement or a brighter future for their children. Instead, they watched in horror as their hard-earned money evaporated before their very eyes. Amidst the chaos, rumors swirled of further market intervention by the Thai government. Some welcomed the prospect of intervention, seeing it as the only way to restore order. Others feared it would stifle the market and scare off foreign investors in the long run. The SET had a tough decision to make, one with far-reaching consequences. In a dramatic move, the SET announced a temporary ban on short selling. This drastic measure, designed to curb speculative trading and halt the downward spiral, was not taken lightly. It was a clear signal that the SET was willing to step in and intervene in the market to prevent a complete meltdown. In addition to the short-selling ban, the SET implemented a series of trading curbs, including lowering the daily price fluctuation limits for stocks. This move aimed to limit the speed and severity of price movements, providing a much-needed breather for the market. These measures, while temporary, were significant. They reflected the gravity of the situation and the SET's determination to restore stability. The government, in a show of support for the SET's actions, announced its own set of measures to mitigate the impact of the US tariffs. These included financial assistance to affected industries and efforts to diversify Thailand's export markets. The message was clear: Thailand was not going down without a fight. The SET's intervention had an immediate impact. The bleeding stopped and the market stabilized, albeit at a significantly lower level. The short-selling ban, in particular, drew mixed reactions. Some lauded it as a necessary evil, a temporary measure to prevent further carnage. Others criticized it as market manipulation, arguing that it interfered with the natural forces of supply and demand. The SET's decision to intervene in the market ignited a heated debate. Critics argued that the measures, while well-intentioned, set a dangerous precedent. They feared that it would deter foreign investment, painting a picture of a market too unpredictable and subject to government interference. Transparency and a hands-off approach, they argued, were crucial to maintaining investor confidence. Supporters countered that the situation demanded swift action. The SET, they argued, had a duty to protect investors, especially vulnerable retail investors, from predatory short selling and irrational market behavior. The temporary nature of the measures, they stressed, would not permanently damage Thailand's reputation as an attractive investment destination. The debate highlighted the difficult balancing act faced by regulators in times of crisis. On the one hand, they have a responsibility to ensure the smooth functioning of the market. On the other hand, they must guard against excessive intervention that could stifle growth and innovation. The SET's actions, whether deemed necessary or excessive, would undoubtedly shape the future of Thailand's financial markets. The long-term implications of the SET's intervention remain to be seen. Would it be a one-off event, or would it mark a shift towards greater regulatory involvement in the market? Only time would tell how this episode would shape Thailand's financial landscape. One thing was certain: the events of April 2025 served as a stark reminder of the interconnectedness of the global economy and the ripple effects of geopolitical tensions on even the most seemingly stable markets.